side of the very bottom, Steve Entin is currently the President and Executive Director of the Institute for Research on the Economics of Taxation. Prior to joining the Institute, he was the Deputy Assistant Secretary for Economic Policy at the Department of the Treasury, and before that he was a staff economist at the Joint Economic Committee on Congress. So please join me in welcoming Steve Entin. He's got a PowerPoint.
This and into the main menu. There you go. Well, while we search for a technical person,
Please bear with us. How about this one over here?
There we go. Okay.
That's pretty quick.
That's right.
It takes longer. You guys are good for something.
I'm older than Doug. Doug has something of the gift that Ronald Reagan had. He can put difficult concepts into enjoyable, entertaining English and actually get it right and make everyone understand it. I rely on graphs and numbers. So what I'm going to try to do is intersperse the graphs and numbers with a little bit of stand-up comedy. I did not agree to talk about a revenue-neutral tax reform. I don't believe in revenue-neutral tax reforms. I think we should whack spending and have a great big whopping tax cut, but that's just me. Neutrality is not just philosophy. Doug is not just expressing his whims. There is darn good reason to want it, and the way Doug described the steps is not just imaginary either. You actually have to do what he said to get where he wants to go and where we should be going. My mentor, Norm Turre, used to talk about 4 attributes of a good tax system: neutrality, which is related to economic growth and efficiency; simplicity, fairness, but watch out how you define it; and something called visibility. He didn't want a lot of people off the tax rolls. He thought that the voter/taxpayer ought to know what the people in Washington were doing to him so he'd know how to throw them out of office every November. So with that in mind, there are really 2 considerations: not just rates, but base. And let me give you an example of why. I can cut your tax rates in half tomorrow without any damage to the federal budget. Line 1, put down your income. Line 2, multiply it by 3. Line 3, pay tax on line 2 at half the old rate. Cut your rate in half, but your tax has gone up by 50%. I'm sure there's a gimmick there somewhere. And when I hear about tax reform, and I listen to what's going on the Hill, and I read the Bowles-Simpson Commission, and they want to take this deduction away, and that deduction away, and that deduction away, and I'm thinking, wait a minute, those last 3 were costs of doing business. How can you pay tax on something that isn't more than your costs? I mean, be careful what you wish for, you may get it. Doug has to educate the Congress between now and February 3rd if he wants tax reform early next year on what the right kind of tax changes are. Now, Doug listed them, but I don't think the members of Congress have quite caught on to it yet. One thing we hear going on right now is we're going to get rid of expensing of plant and equipment and lower the corporate rate, and there are even some businesses that like that idea. But if you don't have expensing, you've mismeasured income, and you've tripled your income on line 2, and then you've cut the rate, but you still come out behind. And the members of Congress are listening to some business people who are pushing that because they don't have any depreciable assets in their business, while people who have depreciable assets are going to be shafted. So we've really got to focus on what is the right tax base. And it isn't the income tax. It's not income. It's sort of consumption, but more correctly, it's a neutral tax base. And I'll try and explain what I mean by that. First of all, let's get rid of this fairness nonsense. Income is not manna from heaven that dropped to the ground, and whoever has the sharpest elbows and the biggest shovel gets the most of it. Income is the earned reward for providing labor and capital services to the market, for producing something that other people want. We earn our bread by making other people happy. And it's proportional to effort. And so the fairest tax is really a flat tax on income properly measured. Now, we should exempt the poorest if they can't afford to pay, but that's kindness, not fairness. Fairness is a flat tax rate. Income is a net concept. Profit isn't profit till your revenues exceed your costs. You have to deduct your costs. we don't deduct all the costs today, and that's part of the problem. Saving is a cost of earning income. You can't get the interest on the bond unless you buy the bond. You can't have your principal and your interest too. You can't have your cake and you eat it too. The best measure of income is actually consumption, the part of your revenue that you didn't save or invest. That is what you are consuming. And this is not a new idea. Neither is the concept of taxing territorially. I want to perhaps get two quotes out of the way before I go any further. When I say these are not new ideas, we certainly have had scholars in the tax literature, like Doug, going back a few decades, but some older people than Doug going back a few more decades. But even a few decades isn't enough. In The Wealth of Nations in 1776, 236 years ago, Adam Smith said, "The proprietor of stock, the businessman, is properly a citizen of the world and is not necessarily attached to any particular country. He would be apt to abandon the country in which he was exposed to a vexatious inquisition in order to be assessed to a burdensome tax, and would remove his stock to some other country where he could either carry on his business or enjoy his fortunes more at his ease. By removing his stock, he would put an end to all the industry which it had maintained in the country which he left." Well, we should have had time to read that book by now. Okay? Now, the tax that we have today, the income tax, is heavily biased against saving and investment. And perhaps you'd like to know why. The father of the income tax, who wanted to tax saving, even though it was the cost of earning income, was Henry Simons and his friend Robert Haig. And here's why he wanted it to be structured that way. The case for drastic progression in taxation must be rested on the case against inequality, on the ethical and aesthetic judgment that the prevailing distribution of wealth and income reveals a degree and or kind of inequality which is distinctly evil or unlovely. If you built your business yourself, first of all, you didn't, you know that, don't you? But if you built your business yourself, you're evil and unlovely. The last is simply uncommon. The degree of progression in a tax system may also affect production. Gee, might it? And the size of the national income available for distribution. In fact, it is reasonable to expect that every gain through taxation and better distribution will be accompanied by some loss in production. Okay? He admits it. His disciples don't, by the way. They think that taxing and spending makes the economy bigger, not smaller. But the person who invented the system they love disagreed with them and said so honestly. If reduction in the degree of inequality is a good, then the optimum degree of progression must involve a distinctly adverse effect upon the size of the national income. Let's lower the GDP and spread it around more evenly. He'd rather have everybody poorer than have any inequality. With respect to capital accumulation, the consequences are certain to be adverse, blah, blah, blah. His remedy for the effect on capital formation was not to do away with the progressivity. He was going to offset its effect on saving by running federal surpluses. I won't bother with the quote. Simple Simons. When Washington gets its hands on money, it does not run surpluses. Now, Professor Alfred Marshall, who wrote his first textbook in 1890, and the one I got a quote from in 1920, which is close to 100 years back, said, well, all right, we have to have some progressivity in the system. It's generally accepted. But the system of taxation should be adjusted in more or less steep graduation to people's incomes, or better still, to their expenditures, for that part of a man's income which he saves contributes again to the exchequer until it is consumed by expenditures, English exchequer. And he pointed out, basically, you don't have to have repeated beating up of saving and investment in a tax system to have a progressive tax system. You can have a consumption tax that is somewhat progressive and graduated. You don't need to go through what we're going through. Well, what are we going through? We tax capital more heavily than income used for consumption, and taxing capital is one of the dumbest things you can do because it runs away, as Adam Smith pointed out. You have to have a shrinkage in the capital stock to raise the return, to pay the tax, and that shrinkage is big because the supply of capital is very elastic. There's less elasticity in the supply of labor, but there is some, and so you shouldn't go overboard on labor taxation either. But when we wanted to stimulate a few months back, what did we do? We cut the payroll tax, which is one of the less damaging taxes, and we are now talking about raising taxes on capital, and we did in the health care bill. And when you raise taxes on capital and lower taxes on labor, you shrink the economy. Because the capital stock shrinks a lot, the labor supply only grows a little bit. What happens when you tax capital? What if you have a trucking company with 5 trucks, and the 5th truck's only used part-time, and it really isn't earning much more than its own cost? And the government comes along and says, let's not have expensing anymore, let's make you write the truck off over 5 or 7 or 10 years, let's make the asset life look longer and longer and longer to raise some money for the government real fast. Well, all of a sudden the 5th truck's not profitable, and when one of the trucks wears out, it doesn't get replaced. The business didn't notice much change because it wasn't earning much on the truck anyway. But I have to ask you a question. What happens to the wages of the 5th truck driver? You see, he's the one who gets zapped by this because the demand for labor falls, and never mind the technicalities, you get less wages and less employment. Well, let's point out that this is not a small problem. When you earn your money and you pay your tax on it, and you buy a jar of peanut butter and a loaf of bread, you can eat the sandwiches and the government won't bother you again. At least not the federal government. States will, but the federal government doesn't have a sales tax on peanut butter. It has a subsidy on peanuts, but never mind. You can buy a television and watch a stream of programming, and we don't tax you again. If you buy a bond and get a stream of interest, we tax it. If you put money into corporate stock, we tax the dividends, and if the earnings were retained, the capital gains. Then if you put it into your own business and get some profit, we tax that. So the stream of earnings on the after-tax saving is taxed again. That's double taxation to begin with. Then if you put it into the corporate stock, there's also the corporate tax before the dividend tax, before the capital gains tax, which is the 3rd layer of tax. And then if you've accumulated enough to keep an elderly couple in an assisted living facility for 10 years, you've gone over the exempt amount on the death tax, and we don't just take the income away from you, we take the assets. Now, that's just wrong. So, how do you fix it? As Doug pointed out, you treat all saving like an IRA. You defer the tax on the saving until you take it out later, and you don't tax the inside buildup. That takes care of the basic bias against taxation on layer 2. You end the double taxation of corporate income. You either tax it at the corporate level or the individual level, but not both. It's called corporate tax integration. And you kill the death tax. Note the sickly green on the screen. Okay, IRAs and so forth. Since I was asked to talk about neutrality, I'll actually give you an example. Suppose you have no tax. You earn $100 and interest rates are 7.2%, which they used to be. You could either spend the $100 today or put the money in the bank and take it out in 10 years and spend $200, 2 to 1. That was your incentive to save. Now let's take a sales tax. The government's going to have 25% sales tax. You can spend $80 out of the 100 today. Or you can put the $100 in the bank, let it double to 200 in 10 years, take that out, spend $160, and you'll owe $40 in sales tax. Whether I tax you today or tax you later on your consumption at the same rate, the after-tax ratio, 160 to 80 in this case, is still 2 to 1. But if I keep taxing that income inside build-up all these years, the way they do in the income tax, you're only going to grow it to 140, and you've lost out on a lot of your potential consumption, and the ratio is only 1.75 to 1, and we've hit saving. That's the mathematics behind the thing that Doug talked to you about in simple English. He didn't make it up. It's really there. We have 2 offsets to this sort of thing in the current income tax. We have IRAs and pensions where you defer your saving and let it grow tax-free and then take it out and tax it later. And we have the Roth IRA where you tax it up front and then we don't tax the returns, and they both yield the same $160 as the sales tax. And again, the ordinary income tax zaps you. I'm putting this up to show you that whether you have what is called a consumed income or personal expenditure tax where you file the tax form, your income's on line 1, you subtract your saving on line 2, you pay tax on what's on line 3. Or you have a sales tax where you take your money to the store, that which you did not leave behind in the bank, and go to the cash register and pay the tax on your income minus your saving that's not being spent yet. You have the same tax base. It's just 2 different points of collection. And the value-added tax is a sales tax collected in stages. That's the same thing. And the value-added tax, a business will deduct anything it bought from a firm at a lower level of production, including immediately expensing any equipment or buildings that it purchased, not depreciating, expensing, so that you're taxing Final consumption minus investment, which is income minus saving, which is the same thing. And then you have the flat tax like Holland or Bushka, where the capital is treated like the VAT, but the wages are deducted and you pay tax on your personal tax form on your wages, but not the capital returns. They are all based on income minus investment, which is basically consumption. Although very high returns, unexpected windfalls on capital are part of that tax. They're not covered by the expensing, and that's perfectly okay. So pick your alternative tax system the way you prefer it. I prefer the consumed income tax. I want you to fill out a form at the end of the year and get very, very angry at Washington when you see the total. But you could do a sales tax and have it nickel and dimed out of you every time you go to the store. Just save your receipts and please add them up once in a while and see just how bad it is. But do one of these things and you're going to add about 10% to the GDP, and everybody could use that. Saving for retirement, $1,000 a year for 40 years, whatever. In an IRA, you'll see $400,000. In an ordinary income tax account, it's less than $240,000. That's what we lose. And that's why we can't stand on our own 2 feet in retirement, and we need to rely on Social Security that's going broke. We don't treat saving properly. Everybody should use the IRAs. In fact, all savings should get this. Why this fuss over expensing? Doug is saying, gee, you paid for it up front, you ought to get the tax break up front. But why? Technically, why? Because if you don't get the expensing up front, you're giving an interest-free loan to the government. I cannot buy a machine in slices. It may be declining in value gradually over time, but I have to put the full purchase price into it up front, and I can't use that money for anything else while I'm holding the machine. Now, what happens when you compare expensing to depreciation? Let's take the 7-year asset. I'm going to spend $1. If I expense the $1, I've realized my full cost. Then if I earn some revenue down the line, I should pay tax on it. But if we have no inflation, and I have to drag the depreciation out over 7 years at a 3.5% real return, I'm only running off 91 cents in present value, which means I'm overstating my income by about 9 cents for every dollar of investment. If there's 3% inflation, I'm only getting a present value of 85 cents on the dollar. I've got 15 cents of income from that machine that isn't really income, but I'm being forced to call it a taxable event. And if I'm only earning 15% on the machine to begin with, I've doubled my taxable income, and my 35% rate is 70%. And if we go down to a higher rate of inflation, higher than I've shown here during the Carter administration, you have so exaggerated the income of companies with capital that they're reporting taxable income when they have had real losses. And they're paying over 100% tax on their real income. These apparently small changes in timing make a difference. I was in the audience when Charles Schultz was chairman of CEA during the Carter years, and he talked about the budget problem. We couldn't cut taxes, and we had to have revenue neutrality. All right, okay, fine. It came time for this young kid from a Hill staff to ask a question in front of this panel, which included a CEO of a major steel company and a CEO of a northeastern utility. Mr. Schultz, with the inflation, blah, 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 depreciation, blah, 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 what would happen if we started adjusting depreciation for inflation and a real rate of return, like an interest rate or something, so that it wouldn't lose this real value and we could promote some investment? It wouldn't cost very much up front. Oh, yes, theoretically that's correct, but there would be some budget impact, and we can't cut spending because Congress, and we don't know how to do it. Well, anyway, it's too much for the deficit right now, we can't do that. But theoretically it's correct. And the electric utility executive said, oh no, I don't want replacement cost accounting. And the steel executive said, why ever not? And the utility executive said, if our shareholders ever found out we were really losing money, they'd have my head on a platter. And the steel executive turned to him and said, what's happened to your stock in the last 18 months? Well, it had dropped like a stone. Who was kidding whom? In business school, people are taught to throw away depreciation and use cash flow and value the companies on that basis, and so are stock analysts. And all the reports had come out saying that this company was actually in the hole and the stock had dropped like a rock. Who did the executive think he was fooling? And I say that because some executives today are saying we will give up expensing for a lower corporate rate even though it raises our actual tax bill, because it will make things look better on our bottom line, because the accountants don't give us credit for the delay in the tax payment by having accelerated depreciation. We'd rather pay more tax and make it look better.
Maybe
they're advising the senators, and some of them are falling for it.
Maybe they'll get a bailout.
Okay. Let's not tax corporate income twice. I'll skip over this. Now, the death tax, I'm hoping a lot of people in this room are rich enough to be worried about this tax because these are neat charts. This is where we are now. The estate tax is 35% with a $5 million exempt amount. Now, the next column, the IRS doesn't want people to feel left out. If you give your money to your grandchildren, your children might feel left out. So we pay an estate tax, and then we pay another tax on what's left called a generation skipping tax, so they pretend that the children are already dead and we've given it through 2 generations. Now, that puts the rate up to 58%, and if you are actually putting interest from some savings you've done into the estate, then you have to pay the income tax on your saving and the state income tax on your saving and then the estate taxes. And if you're working for it, you have to pay payroll taxes, and you've got a 78% total rate, which is pretty oppressive. But going back to the Obama proposal to go back to the 2009 rates, or worse, going back to the pre-Bush tax cut rates, you've got a 90% rate at the top over there. Who'd save and invest with that hanging over their head? Put it another way, at a normal rate of return, if you're building a business, 7% or so, and you can reinvest it all and live on your wife's teaching salary, you can build your small business up and double it over about 23 years, generation. And then the government steps in and takes 55%. You're right back where you started, where your children are. Then they build it up over a generation, double it again, and the government steps in and takes 55%. How can you ever get ahead? It's outrageous. Okay. 4 general types of neutral taxes: the personal expenditure tax, income minus saving equals taxable income, and a few other deductions for investment in your business or investment in education. The Army flat tax, the sales tax, the value-added tax, all of these have the same base where they get rid of all of these additional layers of tax on capital and treat you just like you were being treated under a neutral tax. And they employ expensing, they are territorial, and they are different mainly as to the point of collection, and you have to decide whether the ease of filing, of having the government collect it at the store from you, beats having to file the paperwork and seeing more clearly what the government is taking from you. That's the basic choice you have to make in deciding which one of these to do. When we have moved toward the more neutral tax bases under the various presidents that have allowed this, the economy has generally taken off and done very, very well for the next few years while we build up to the new higher desired capital stock. And when we've moved in the other direction, we have generally beaten down the economy and it's stalled out for many years because investment responds by simply not being done and going away. Kennedy and the first Reagan cuts were very much in the movement toward a neutral tax system. We backslid in Reagan with the 82 and 84 tax increases pushed by the Hill and the Tax Reform Act of 86, which broadened the base by closing so-called loopholes and lowered the rates, fine, except that many of the loopholes they closed were offsets to the high deductions and overstatements of income. We raised the capital gains tax, we lengthened asset lives, we got rid of the investment tax credit, and that did more damage than the good done by lowering the corporate rate. It was a borderline thing, but it wasn't quite good enough. The Bowles, Simpson, and Wyden-Coates bills that you see floating around are so bad, they go back all the way in Wyden-Coates to the worst tax treatment of capital investment since the Eisenhower administration. And you get a pattern of projected impacts on GDP that looks something like this. Growth under Kennedy, slumped during the Johnson surtax, mixed bag Nixon, Ford, Carter, good Reagan, 81, bad Reagan, 86. Bush raised taxes again. Clinton raised the top tax rates, although the House did force him to cut the capital gains rate. And Bush, very good in 2003, but not in 2001, because most of the stuff was delayed so long that it didn't take hold in time to prevent the recession. And with the recession, we ran into budget problems, and as Doug pointed out, if you have a problem with the economy, you're not going to get revenues. What Obama would let happen would be a mess. Do we have any proof in the economy that this works? Never mind my model projections. Well, yeah, let's just take a look at what happened. In 2001, we had a tax cut that was phased in so slowly that virtually nothing happened in 2001. You had that silly rebate check on the 10% bracket. That's all that happened. Investment spending continued to fall, and investments in equipment, and in structures, it continued to slide. In 2002, we had 30% bonus expensing, and equipment spending leveled off starting in the quarter the bill passed. Structures didn't get it, they continued to slide. In 2003, from the quarter the bill passed, we accelerated all remaining rate cuts. We cut the capital gains and dividend taxes to 15. We went from 30 to 50% bonus expensing. The economy took off like a rocket, the investment in equipment took off like a rocket, and structures began to recover. It works, and it works fast. This is what Wyden Coates would do. They'd raise the tax on capital gains and dividends to the mid-20s. They'd lower the personal rates, but that's not enough to offset the damage done by the capital gains and dividends. They have horrible treatment of depreciation. It would be a disaster. We don't need a repeat of '86 writ large by Wyden Coates. When you raise the tax on capital gains, people stop taking them. And CBO for years, before Doug got there, okay, this is not his fault, but CBO for years said, well, it's just a timing effect. They'll stop taking gains this year, but they'll start up again next year when the rate goes up. No. It fell for a decade, and it stayed down for a decade until it was cut again with Gingrich and Hastert and Bill Thomas over in the House. So that doesn't work. You're never going to get any revenue doing that. So let's skip over. There are several elements of the tax code that are not adjusted for inflation. Doug mentioned the alternative minimum tax. In the 80s, we were trying to roll back some of the bracket creep that had occurred in the 70s and that had strangled the economy. And Reagan said, okay, we're going to cut the tax rates and then we're going to adjust the brackets to make sure you don't get any more bracket creep. That was my chart. I'm very proud of it. But he said in one little picture and in one short sentence, if you want a permanent tax cut, call your congressman. I'd given him all these crazy formulas that I showed you a few minutes ago with all the tables. He just put it in a couple of words. Inflation is raising your taxes. We're going to adjust for that. They're not. If you want a permanent tax cut, call your congressman. And the